Hello everyone. In this learning objective, we understand the small farm effect, considering it as a potential example of growth investing, and also discuss some of the limitations of the application of this particular approach. One of the most widely used passive growth strategies is the idea of investing in small cap companies. The idea here is that you might have a small immature farms that have greater growth prospects. While the substantial empirical evidence supports this strategy, there is actually some debate whether or not the additional returns from this investment strategy is simply be just a compensation for risk. Also, the question of whether the abnormal returns from this investment approach that we see when we do statistical analysis of a small farm effect can actually be exploited in terms of a real world investment strategy. So let's first begin by looking at what the research evidence shows us about the small farm effect. There is a vast body of research that shows that if we look over a long time period, the small farms tend to earn a higher return compared with large farms. On screen, here we can see portfolio based on market capitalization of farms, and these portfolios are rebalanced annually. We can see that the smallest decile of stocks across the period 1926 to 2008 earned an average annual return of 19.3%, whereas this average annual return decreases all the way down, and the largest stock portfolio's average annual return is only 10.77%. So this difference between the average return of the small and largest section of our universe of stock is what we call the small farm effect. I mean, the difference between the largest portfolio and the smallest portfolio in terms of market capitalization is the small farm effect. Now, there are a couple of interesting phenomena to identify as we are looking at this small farm effect. Most particularly, if we are looking at the premium, we can see it's really driven by the extreme performance of the very small decile stocks. You can see here. At the very small decile stock, there is a return of 19.34% and it's drop off quite a lot just in the second decile. So even though we can see that this continually decreasing return as the decile gets larger, but none of the drop-offs are quite as big as the first one. So a key question around whether this strategy is exploitable or not, whether we can actually feasibly invest in this smallest decile portfolio. And if we can't, you can see that we cannot exploit this small farm investment strategy. This is the evidence from the United States. So what happens when we look at Australia? Here we have our size-based portfolios across the period 1975 to 2006. Once again, we see the same phenomena. Average monthly return of the smallest quintile stocks are very high, and average monthly return of the largest capitalization portfolio is pretty much low. And we can see the same phenomena that average monthly return of the smallest decile is pretty much higher, and it decreases substantially for the other quintiles. So we see the same phenomena that we have seen in the US. That is, the side effect really appears to be driven by the smallest segment of the market. Now, what long-term periods have demonstrated that investing in small farms does appear to be an effective investment strategy, there is some suggestion that this strategy has not been effective in recent periods. A range of academic studies have actually identified that side effect has disappeared in the recent decades. Jeremy Siegel, in his book, notes that the side effect and its outperformance is really largely driven by the outperformance of small farms back in the 1960s and 1970s. So keep this in mind. Let's break down the side effect across decades and let's have a look at what the results actually show us. So we can see here an average size premium, I mean the return differential between the smallest decile and the largest decile of stocks, and this analysis is for the US market. You can see these bars. These bars basically represent the return difference between the small and large cap stock. We can see that during the 1930s and 1940s, quite a large size effect. However, they didn't tend to exist in 1950s. But again, a large side effect is found in 1960s and also in 1970s. This is Jeremy's point from his books where studies started to talk about the disappearing side effect in the 1980s. We can see in 1980s and 1990s the size premium was negative, you can see here. This implies that large firms actually earned a higher return than small firms. However, we can look at the performance of a small firm in the 2000s and we can actually see that there appears to be a return of the effectiveness of the small firm investment strategy because across this particular decade, small firms outperform large firms by an average of about 1% per month. So while people have argued that side effect has disappeared and hence there is no longer an effective investment strategy in relation to this, the most recent decade may give us some evidence to suggest that there may be some basis for considering investing in small firms going forward. So if we are considering an investment in small firms or trying to exploit the side effect, we have to identify what the explanation might be for this phenomena and hence identify what investment philosophy might align with it. Well, there is a whole lot of evidence that suggests that side effect may be just a compensation for risk. But in this case, we are talking about maybe dimensions of risk outside systematic risk or beta that's measured by CAPM. Vassallo and Jing in 2004 looked at this argument and they identified that small firms have higher exposure to default risk and that may be potentially what's driving this small firm effect. Similarly, there's been a whole lot of studies that have shown that size premium tends to vary with the business cycle. That is, small firms tend to do well when economy is doing reasonably well and tend to do poorly when the economy is not doing very well. And this procyclical variation with the business cycle is indicating of the fact that a small firm effect may be a compensation for some sort of economic risk. However, there is some other explanations for the side effect that are related to market frictions. A common argument is associated with liquidity. As we expect, small firms are less liquid. We know that there is a bigger bid-ask spread and bigger price impact for small firms. Hence, potentially, we may see that the small firm effect is a compensation for liquidity risk. A range of studies have looked at this issue and identified the fact that small firms are obviously less liquid and seek to explain the side effect in terms of liquidity and argue that this may be a driving force behind the small firm effect. Another potential explanation for side effect is information asymmetries. In the universe of a small stock, there tend to be less information available for these stocks. The graph shows the percentage of stocks that are covered by analysts and average number of analysts covering each stocks in the US market. Okay, so in this axis we show the percentage of stocks that are covered by analysts, and in this stock we show the average number of analysts covering each stocks in the US market. We can see that as far as the large cap is concerned, the majority of large caps and quite a large number of mid caps are covered by at least one analyst in the US market, and average number of analysts covering each stock is well below in compared of the micro cap in compared to the large cap stocks. So given this less analysts covering small stocks, it may be expected that there is less information available, and such information asymmetry creates a risk, and hence maybe investors demand a higher return for investing in those micro caps. There are a few other potential explanations for size effect. There is a bunch of studies that identify that size premium is really driven by excess returns in the month of January, and there is no side effect in months thereafter. So potentially side effect is just a calendar year phenomena. So if we look at returns of the size effect in January versus non-January month in decile portfolio in the US market, here is the evidence we have. So you can see the red bars that shows the monthly return of different decile portfolios during the non-January period, and the blue bars are the decile returns of the January months. Now, if you look at the January month's return, you can see a very clear example of size effect because the smallest decile portfolio in terms of market capitalization generates a pretty much higher return compared to the largest decile portfolio. So there is a significant size effect. However, if you look at non-January returns across the decile, you can see that returns are almost similar across the decile, indicating there is no evidence of side effect. So you can see that side effect is only evident during the January months, but not in non-January months. So potentially some of the arguments that we see for the January effect in the literature, generally issues like tax loss selling hypothesis or window dressing, potentially are explaining the side effect. So it's debatable whether or not the side effect actually exists. Another question that we have to move to if we are going to execute the side effect as an investment strategy is this investment strategy economically feasible to exploit? So when we are identifying whether or not we can invest in small stocks, the first question is to identify which stocks comprised the universe of small stocks. There's a range of different ways we can think about this. In line with the academic studies, maybe we could think of investing in deciles. However, in Australia, the smallest decile stocks have a median market capitalization of around $2 million. Yes, $2 million, the whole farm's market value, which is basically the price of a house in Sydney. These farms are so small and so illiquid that it is just not feasible for any reasonably sized fund to be placed in order to buy these stocks. So it's pretty apparent that we can't buy the smallest decile stocks. We can think about other academic studies such as Farmer and French, which split the universe of stocks at the median half and identify the stocks below the median as being a small cap. If we do so in Australia, the median market capitalization is still around $20 million. So we are still talking about really small stocks that we can't physically invest in. So even the middle stocks in terms of market capitalization in Australia is too small for an institutional investor to go about buying so. We can't really even feasibly exploit the size effect in terms of the bottom half of the stocks by size in the Australian market. So can we go about exploiting it? Research suggests that the statistical returns generated by the size effect in Australia is really subsumed by transaction costs because of the fact that these particular companies are so small. Now we all know that there are some funds that do attempt to exploit the side effect in Australia. These funds look at the smallest companies that are listed on the ASX 300. They might be, for example, defining the top 100 stocks as being large and between stocks number 100 to 300 as being small cap, and then between 300 to 500 being micro cap stocks. So the question is, if we are going to define our small stocks in such a way, the question is there a side effect in terms of a return differential between the large 100 stocks and say the next 200 stocks, or is there an exploitable side effect? Here we have looked at the returns of the ASX 100 versus the small ordinaries index. If we look at these returns across time, we see that they follow each other quite closely, and the return difference across time on average is very close to zero. You can see it hovers around zero. The return difference is 0.77% per annum on an average, which is statistically not different from zero. So this result implies that if we are using the definition that top 100 firms are large caps and number 100 to 300 are small caps, with a view of the fact that in Australia, potentially only 300 larger stock companies comprises a feasible set of investment, it does not appear that side effect is working or side effect can be exploited. So while there is a pretty strong academic evidence and statistical evidence that shows that before incorporating transaction costs, there is side effect, this is something that's very difficult and potentially be impossible to exploit as an effective trading strategy in a market like Australia.